Hi, this is Randy Finney with Right Side of the Chart, and this is a late session update for Tuesday, December 5th, 2023. It is 2:58 p.m., so we have just about an hour to go in the trading day, and hopefully I'll be able to get this one out before the close. Really nothing time sensitive, however, so if you don't get this till after 4 p.m., I don't think there's anything really it's going to make a difference on that. So here's how I'm going to do this video. We're going to start out because I did want to do an update on crypto. Crypto's really been strong lately, and I mentioned yesterday Bitcoin being at resistance, and today we have Ethereum, and of course that's they've been powering through resistance, so there's things to like in the charts and things maybe not to like. So I'm just going to do an update because I know that's usually a crowd favorite. I haven't been covering it a lot lately, nor trading it. I thought about taking a position. I'm still just watching for now, and I'm on the sidelines observing. So this is GBTC. Keep in mind, GBTC is the Grayscale Bitcoin Trust. It was first to market ETF-like instrument. It's not an ETF. It's not an exchange-traded fund. It's more like a closed-end fund. For those not familiar, an ETF will track if you have, an ETF that, like for the example, QQQ tracks the NASDAQ 100. So, and it's going to price in what all those 100 stocks, what the index is worth, and it's going to track that almost to perfection, up and down, tick by tick, whatever the value is. Closed-end funds trade at a premium or discount to NAV, sometimes at par, but a premium means, if you have $1 million of assets in there, whatever it is, whatever that it's tracking, a closed-end fund, and you have 1 million shares, it's going to trade at $1 a share. If it's all of a sudden it's still worth $1 million, all the value of all the securities they hold, whether it's Bitcoin or a bunch of stocks, whatever the closed-end fund's tracking, if the value is $1 million and it's trading at 95 cents instead of $1 a share, then it's trading at a 5% discount. So keep that in mind. And so this guy here is going to track. Typically, historically, it's traded usually at a discount to Bitcoin. So the levels, especially over time, aren't as hard. I could pull, and I didn't do it here. And probably, if you're interested, again, I'm not really engaged in this now, but I would pull the charts of Bitcoin Cash, Bitcoin US dollar, Bitcoin futures, and all that other stuff. I just want to say it's still in that very close proximity to that pretty significant resistance. Negative divergence. I always say divergences are not a sell signal. Negative divergences, just like positive divergences, are not a buy signal, but they tend to foreshadow trend changes. So there's that. We'll watch it and see if there's any play. But right now, again, it's just something to keep an eye on. It keeps burning through. We've had divergence. I started pointing it out back here, even threw it as a trade idea, and it just kept going and going. And my suggestion was, because divergences can build, was to put a stop over that previous high right there where I highlighted it. Just before, I had a little wedge here that broke down, but then it snapped above. So again, you can see these divergences building, but still very much intact on the 60-minute and daily. And if we do get some kind of catalyst or sell signal, that's that former first target, still the first target. Now we're just farther from it. It'll be about a 31.5% drop from where we're at. So there's Bitcoin, again, just via GBTC. Then Ethereum traders, you have ETHE and ETCG. This is ETHE, Grayscale Ethereum Trust. There's a gap right here from May. Looks like right there. You can see the gap from early May of 2022. There's the bottom of the gap, a couple reactions, and the top of the gap. Right now, we're coming up to the top of the gap. That's resistance about 1920. Just like Bitcoin, you do have negative divergence building on the indicators here on the daily chart. As you do, I haven't updated it. You can see how they burn through. In fact, those old divergences were taken out completely. Now it's a new set here. That was the uptrend line, which it just chose to ignore on these two punches down below. So I take these lines right here and move them over and show you that we now have, actually this divergence has gotten bigger on the RSI. It was a PPO divergence I had to reset from this point here. So that's that. So it looks like a pullback is coming. This is certainly a pretty frothy trade right now, to say the least. That's it. So, and of course, if you're in it or anything else, I don't track the altcoins because I can't. I only track what I can trade via broker, regular traditional brokerage company. I don't deal with crypto stuff. ETCG. There's the original Ethereum Classic Trust with the original Ethereum. It's right there. 1168 resistance, not super big resistance, but negative divergence as well. And you can see this is a 60-minute chart. So I just wanted to point that out. There they are. They all have divergences. Volume could be indicative of a buying climax, but not so much really. It's just kind of a big volume surge. Let me move on. All right, so here's how I'm going to do the rest of the video. I want to go to the site, and as I've been doing lately, more and more so, because we're getting a lot of good questions. We get questions, in the comment section on different things, and so I'm going to pick up where we left off. I think in the last video, which was right here, yesterday's video, I covered the questions up to this point. So the only ones, unless there have been additional questions here, I don't know if there are, just bump me on under the comment section of this post that I'm recording right now, and I'll try to get back to you. So let me go to this first one here. This was from yesterday. Comments on VXX. Almost had a PPO crossover today, maybe tomorrow. All right, so this will also kind of ties into my analysis on the markets. Remember QQQ. We do have, let me pop up the PPO histogram. As I told you yesterday, we would see that bearish PPO crossover confirmed, barring any super mega rally into the close, which I didn't expect. So we got it, and today it's still there very much. So right now, again, I'm referring to the red histogram bars showing the PPO's crossed over. I've gone over the history of that quite a bit. So that sell signal is in play, and that's what that is. It is a sell signal, more so of a, it's a timing indicator. I like to really get more precise with the 60-minute charts, and it's not a be-all, end-all, but it is that, and so we're going to treat it as such. So on that, that brings me to VXX. Now, VXX, remember, is an ETN tracking VIX futures, and yes, it is about to cross, and yes, you can also look at the history of that as well. Measure it. There's the last one we had right there. That was not a big hill. Remember, I look at little spikes. That's a whipsaw. These are your big red hills. So let me show it to you on VIX, the actual VIX volatility index, and that'll be a little clearer. We actually got that yesterday. Again, no mere coincidence. We got the crossover on QQQ. Now, the VIX, I know, tracks the S&P 500. Before anybody tells me I'm aware, there is a VIX volatility index for the NASDAQ that's VXN. And I don't really, it's not as liquid as all the derivatives and trading options, but it also triggered yesterday, just so FYI there. And you can see the last time we had a little hill right there, call that more of a whipsaw. There was a big red inverted hill, and there was your crossover. And from there, VXN, the VIX volatility index, went up 26%. So something to keep in mind. So let me go back to the VIX that most of us trade, the S&P 500 VIX. And you can see right there, that was a bullish crossover. From that point, the VIX rallied, and I went from the end of day close there, 52.5%. So take it for what it's worth. There was a crossover right there, bullish crossover. Oops, next day right there. And from that close, which is down towards the bottom of that candle, the VIX rallied, well, yeah, if you want to say that was the high, about 37%. So it's, bottom line, guys, just like the S&P 500 in reverse. That's what you're looking at the VIX usually. The VIX goes up when the market goes down. And so these tend to capture trends. It's not rocket science, really, what we're looking at here. And look for the big green hills. And that's when you want to be, typically long the VIX, short the market, right? Just like the stock market in reverse. And the VIX, unlike the stock market where you can hold, and you can get bailed out in a sideways trading range, it may ultimately play out in the direction you think the market's going. With the VIX, especially the VIX tracking instruments, remember, you and I nobody can buy this, the spot VIX. It's just a theoretical index based on, it's calculations. What you and I and any professional institutional trader can buy are derivatives, instruments that track the VIX, and those are VIX futures, options on those VIX futures, not on the VIX, but options on the futures, and then the VIX tracking ETNs, which buy and track the futures. So that's it. So And of course, the futures are going to mirror this. They just roll every month, and the thing is, you have those expenses. So you can't sit in. If you sit in the VIX for an extended period of time, you're almost guaranteed in just about all market conditions, especially in a bull market, you're guaranteed to lose money. But there it is. So the VIX is still very constructive. I wanted to update this because nothing's changed. We put in a divergent low there, another one there, and this divergence has been getting bigger and bigger. This is a new and still divergent low. Bullish PPO crossover after a big red hill. Remember, it's these big hills that usually are what you want to look for, and then wait to see the crossover, and then you usually get at least a tradable bounce. Again, it's not 100% effective, but quite often, like right here, it'll help you catch the big moves. And there was a breakout. There's a beautiful price channel in the VIX. There's your breakout candle coincided with a bullish crossover on the PPO. And, even if you waited that day and didn't anticipate it, we probably would have been able to be long the VIX or short the market ahead of that. Let me move that away. It's in my way. But you still had, in just a matter of weeks there, 44% gain in the VIX after that buy signal in the breakout. And that's, again, if you waited to buy the breakout and the buy signal and the PPO crossover. And as posted, I can't remember now, a week ago, 2 weeks ago, these are your, the current price targets for VXX, if that's your instrument. It still has a positive divergence. It just hasn't taken off yet, nor will it take off unless the market rolls over. So we do have that whole, I'm going to get into that in a second, the indexes. We have that whole seasonality thing. We still have Treasury bonds yet to reverse. That's a big one, but the Euro's already been pulling back. Again, I'm going to cover all these things because they were all brought up in these questions, and they're the things I'm watching. Of course, the big three I'm calling it lately: Treasury bond yields, or Treasury bonds and or the yields, the stock market, of course, and the Euro. Okay, so that was the sole question under that post yesterday. Here, I'll zoom in for you guys. I forgot on the videos, you might not see what full-size screen. I'll blow it up a little bit bigger. All right, let's just go in no particular. We'll just go in order of how they were posted. I don't know if you consider this, Randy, but what if we're in for deflation? Oh, absolutely. Certainly, I can see a possible. In fact, there's a good chance. There's a massive credit bubble bursting in, and unlike last time, we had just the market Fed with the ability to keep gunning the markets and creating the bubble even bigger. We could be looking at deflation going forward. Absolutely, we could even be looking, as I answered here, dreaded stagflation. That's when you actually have inflation, declining asset prices, and employment and all this. But there's inflation as well, so it's like the combination of the worst of both. Here's the thing. Yeah, certainly possible. We could have inflation going forward, we can have deflation going forward, or we can have stagflation. I'm taking it one day at a time, and I'll trade each asset class based on their own technicals. So, yeah, there's all these things, and I'll tell you, I listen to one guy or gal speak as to why we're going to have deflation, then I hear the next person get up there and make it just as good a case as why we're going to have inflation or stagflation. So at the end of the day, I do like to factor all that in, but that's not going to... it's not going to affect my position in day-to-day on things like gold, silver, stocks. Like I said, wheat, chart of wheat's bullish as it's been lately, and it's still running. I'll buy wheat and be long wheat. If the chart of the stock market or a particular stock is bullish or bearish, I'm going to be long or short. All right, so I didn't want to spend much time on that. But yeah, certainly a possibility. It just doesn't matter to me. I guess it does matter, but let me move on. All right, Randy, assuming Qs get back up to the 386 area, would it make sense again to add to shorts? Okay, I didn't see that one, so let me look at that. And let's see, 386, QQQ, which we're already at now, or a little bit above. We're at 387 right now. Yeah, depending on your position. Now, that question is going to make me get ahead on the one that I'll get to in a second here, because I already answered it today. Again, this question I just read, I didn't see until now. It must have come in later. So somebody asked, there were a couple comments, one about, the markets and the markets being up. First of all, the market's still, it's just a very, very short-term downtrend, but the market's still off the highs. It's, remember, it dropped about 3% into yesterday's lows. And so what I mentioned to someone, and I showed this chart earlier today in one of the comment sections, questions, is that we're dancing right now in this trend line. Remember, I had two boards on the 60-minute chart, this one with the price targets initially, and I had a little bit different trend line, which may still come into play. And then I have this one. You know me, I'll draw different trend lines, and usually if two are close by, I'll call the lower one the benefit of the benefit of the doubt trend line. If it's a support level, let's say there's two together, you want to give it the benefit of the doubt, wait till the second one's broken. But as of now, this one now has more reactions. So we had the initial two reactions, right? And now you can see as I zoom in, there's additional candles on there that help to validate it. It's not a super strong trend line. I really like to see on a trend line of this length and this scope, it's a short-term chart. We're looking at a 60-minute chart, and we're only talking what is that, a month right there? It's pretty much the end of December. It starts late, the 26th. So yeah, October, I'm sorry. And so it's most of November, a little bit of October, and into December, that trend line so far. It would just, what I'm trying to get at, it would look a little bit better if down here we had another pullback, maybe a couple more reactions along the way. So, on a scale, do that scale 1 to 10 thing. It's certainly not a 10 for a trend line, but it's valid. I always say it takes at least 3 distinct reactions to help validate a trend line. These are really clusters so far. So either way, it's a level that if broken, has a decent chance of bringing in selling. Again, I'm not putting a super high weighting on it, but that's what it is. And as far as adding any shorts, look, I mentioned that the other day. There were levels on the euro you could look, which we already got. A kickback to those levels. There's a gap right here. There's technically would be where you close the day, would be the top of the gap, but there's a couple candles there and a couple spike highs. So this is all resistance. All that's an objective area to add to shorts or initiate, again, depending on your current positioning. Everyone's different. Or you wait for a break of support right there. But the same reasons for shorting up here off the divergent high are still very much in place. We have a divergent high, it's confirmed, and the only difference between now and last week is we have the confirming the PPO crossover on the daily chart of QQQ. And as I mentioned yesterday, 6 out of the Magnificent 7 also have that. All right. And with that being said, it's still, still not an all-in moment. There's still that whole seasonality thing and the Santa rally that tends to, in year-end money coming into retirement plans and other things. We'll see. As of now, the charts are saying the RR appears to be more favorable to the short side because of the divergences and other sell signals that I've mentioned over the last couple of weeks, low-volume sell signal, PPO. But that's about it. It's still not an aggressive all-in short moment. Okay, somebody did that one. Deflation, QQQ. Okay, next one up. Really interesting if you look at the price action in QQQ versus QQQE today. The Mag 7 are holding up the NASDAQ. Absolutely. And complete opposite of yesterday. You've heard me say this once. If you followed me, you've heard me say it 1,000 times. I agree with that, but one day doesn't make a trend. So, Mag 7 are up today, right? And I saw that earlier before I even read this. I looked and pulled up because I noticed the stark under outperformance because I have a watch list of all times of all the components of QQQ on my screen ranked by market cap, and I saw all the top was green and most everything below it, the majority of the stocks were red. So what I meant that the Mag 7, because I sort that watch list or the component list in descending order of market cap. So it's Apple, Microsoft, Alphabet, Amazon, Nvidia, Meta, and then Tesla. And so I noticed all the green and then a bunch of red. And yeah, and you can see that. So QQQ is up 0.2%. QQQE, the equal weight, is down 0.8%. So that just shows you, again, it's, these guys, whether it's their stock buying programs firing off, again, one day doesn't make a trend, but you do want to watch, keep an eye on QQQE. Keep an eye on that for the bearish PPO crossover, which we don't have yet. Same thing with SPY. Very close, you can see that. And you might be saying, well, Randy, SPY is not really going down. Why is the PPO falling? Again, these are momentum indicators. So when you're going up strong and then you start going sideways, you're losing momentum. And it's just, quite often the stock market, it's like a super tanker in the ocean. They don't turn on a dime like a speedboat. They turn slowly, and that's what you can say. And there are no guarantees. I've seen times where they look like they're going to cross or they just barely cross, and then boom, you get another big green hill. I wish I could tell you it was 100% certain, but it's one of many, and so far I'm just checking it off. I've checked off 2 fairly reliable sell signals in the last 2 weeks. My low volume indicator on QQQ, as well as the bearish PPO histogram crossover, additionally confirmed by 6 out of the 7 fangs. And so, if we get something else soon, great. Maybe some type of bearish candlestick topping pattern, or the S&P. We can look at the S&P 500 60-minute chart, negative divergence, divergent high, and what I spy with my little eye is a little cluster. And again, it doesn't have to be. I mentioned the possibility. We still have that. It's getting long for an island cluster top in the NASDAQ 100. For the SPY, here's your gap. So it's not really, you could get it in SPY, but what I'm more focused on is this recent area of consolidation. And you can see the bottom of that is good support. You had a previous reaction high right here in the S&P, a couple highs there. So roll back. There's our previous high from July. Look at this potential double top here. And that was a divergent high. And, I struggle to wonder, there's a lot of doubt on the board. Look, no, not every trade pans out. A lot don't. That's the only guarantee I've ever given anybody on this site, that I'll be wrong, and I'll be wrong a lot. And so that's what stops are for, and that's what, not putting too much into any one position is for, diversification. But, I struggle to see what's different this time. And it, the same thing is when you start seeing this after a big run like that, it's that recency bias, and people think that stocks will never go down again. But what I'm looking at is an almost identical move percentage-wise. Remember back here we had this, it was a breakout right here. I know this is a busy board. You had a breakout right here of the downtrend line, a period of consolidation, and then a breakout. And really you can see from right here, right? We had an almost identical leg up from the same distance, the same negative divergences that we had there. I mean, it's uncanny how it's almost too similar, where it makes me say, oh, that can't work because that's some. But sometimes then you overthink things, and it's paralysis by analysis. So like I said, I'm far from a true mechanical trader. I second guess things. I pass on some buy signals and some sell signals if it doesn't smell right. But for the most part, I try to keep it simple. We've got divergences, overbought conditions, sell signals firing, identical technical posture. I struggle to think why it would be any different, or how I could assign any better odds, any worse odds, or than we had back here. That if a correction is going to come, a tradable trend reversal. These are 60-minute divergences that actually show all the way through. By the way, on the daily of QQQ at least, not on SPY. I will say on SPY we had the divergent high right there. Let me park my histogram and get it out of the way. So we had negative divergence on the daily right there on SPY, but here we do have the pending PPO crossover, and quite often that's all you need. And remember, now on the all, while it's not as representative of the entire stock market, it is the index that matters. It's really looking at the S&P 500 or the entire U.S. stock market through a magnifying glass. That's what you're doing here, because what I mean by that is the same top Mag 7 that are the top components of the S&P are also the top components of QQQ. They're only even more concentrated. They are overweighted in the S&P and contribute to the majority, big bulk of the performance of those 500, that basket of 500 stocks, but it's even more concentrated in the NASDAQ 100. And so I always say, you want to know where the market's going, you just have to know where those 7 stocks are going. And an easy way to do it at once, instead of analyzing 7 charts, because they all tend to move together, is just look at QQQ. And so where I'm going with that is, yeah, we had divergence there. At that time, negative divergence on the Qs. You had it on the 60-minute chart too. And now you have even bigger divergence. The same divergence that started back here, worked our way up with prices making higher highs and the indicators making lower highs, that gave us this drop, which we milked just about every penny of and made it very clear time to cover shorts and go long just before the bottom there, within a few days, a couple of percentage points, if that. Same logic, and that drop was about 12%. Again, biggest drop all year, right? And it was a multi-month drawdown. But now, the only difference I see now between back then is the divergence is even much bigger, indicating the potential for a much larger drop. Maybe, maybe not. We'll see. Only time will tell, et cetera, et cetera, et cetera. But that's it. So that's where I kind of started earlier. There's QQQ. No technical change. Just look at the levels. Break of that trend line could trigger in some more selling. T1 also, remember these were the official targets on this board here. And, my targets are not random. They're placed there for a reason, because upon the initial tag, each level, a reaction's likely. So active traders can cover and go long and play a bounce, and then do the same when the second target's hit, if it looks like there's a decent chance for a bounce. Next target would be the bottom of this gap right here, and that's T2, about 378.40. You always want to cover a hair above the actual support level, and so forth. And then remember, I'm going to move this line now. I had it before here. I'm going to tweak it. It was S1 because it was back here before we even broke it. That means first support. Now support, once broken, becomes resistance. So I'm going to put it as S1, R1. It's really, when you're below it, it's resistance. And I'm going to move it up there because we have this reaction high. And you know what? It fits right here. You can see that shelf of support we had there. And then the gap. So to answer that previous question, that would be a really objective short entry there at 388.70. Likewise, for those that disagree with where I think the market's going, they think it's going higher, a solid breakout, especially a 60-minute and or a daily close above, call it 389. That's bullish, because then you're probably going to run at and put in another marginal new high, maybe even more, maybe even take out the divergences if you're really bullish. That would be great for the bulls to see the PPO and RSI go up and take away all the divergence, and then take it away on the daily chart, and even better on the weekly chart. Wow, man, I'll have a hard time making a bearish case technically. So I don't think that's going to happen, but if it does, those are the things, and those are your both for bull, buy signals, objective areas to go long, and for short, objective levels to cover a short position if we start popping these overhead resistance levels, okay? All right, back to the questions. Same with, SPY and RSP. For those of you not familiar, RSP is the equal weighted S&P 500 ETF, and that's down 0.82% today versus the regular S&P 500 about flat. It says negative 0.01, so a flat. That's a big differential. And again, that shows you the same. It's been a common theme pretty much all year, and more so in spurts such as this one, where you're seeing, and again, guys, don't believe me, listen to those that have been around doing this for a long time. I've been doing this a long time, but there's guys doing it longer than me. And it's the same old thing, and we've seen it goes back to the 70s, with the Nifty 50 back then. When you see the handful of stocks, and it's usually the market leaders, the crowd favorites, doing more and more of the lifting. And again, this is not subjective. This is mathematical. I've heard. I don't write these statistics down, but it's been a huge. In fact, probably, I think I heard one of the most stark the most stark performance attributed to just a handful. We're calling them now the Mag 7, similar to the old FANGs. I don't think we've ever on record seen such a divergence between the equal weighted S&P 500 and the regular S&P 500 has a bigger impact. Same thing with the NASDAQ 100 or the equal weighted. In other words, it's been just phenomenal. And again, it's not a subjective opinion thing here that, they've been leading. It doesn't mean that those 7 stocks did all of the returns, just that they've contributed the vast majority of the returns. And my point is, throughout time, that has been a signature of a end of either a bull market or a big move. This has been a hell of a bull market rally. It's something, I've been talking about for a long time. I think this bull market, I haven't heard, I'm sure there's others out there that share my mindset, but I think others the majority of technical analysts and even fundamental guys are probably, and gals, framing this in the similar comparisons to bear markets we've seen for the last half century, last 40 years especially. And I think it's going to be a whole lot different. Again, the analogy I would use, the best thing is Japan's lost decade. Pull a chart of the Nikkei leading up into the early 90s and how it performed since. And they had very similar fundamental underpinnings with a massive credit bubble followed by periods of ZIRP, zero rate inflation policy, quantitative easing, everything. They were just kind of ahead of us by a few decades. So anywho, and therefore what I'm getting at is I think we're looking at a secular bear market that will be full of plenty of mini bull markets or cyclical bull markets. And if you want to call the rally off the October 22 lows a bull market, sure, by that metric you can. And if you want to call it a bear market rally, as I'm calling it, you can call it that too. Again, it's semantics. It's point is, where are we going, and then how far are we going to go? So if, and it's a big if, but assuming I'm right, I mean, the profit potential to short is massive, and the loss avoidance potential, if you are a typical 401k long-term investor, we have a drawdown, which, I'm looking at my next target, which was laid out way back here before anybody even knew there was a bear market. We hit T3 and we bounced. That's it. So next stop is T4, 235. It's a 40% drop.
Market data
and I could easily see the potential for more. Maybe that happens, maybe not, but I just, so much evidence here. Last time we had negative divergence on the weekly was right here, and that was then. Last time we had positive divergence on the weekly was right here, and that was then. All right, so you can see what happened. This is just a longer term time frame. The same exact technicals work. You just have to be a lot more patient if you're trying to, trend trade off this time frame. All right, let me get back to where I'm going so we don't digress. This is stuff I've covered many times. All right, so that's that. That was the last of that question here. Let's go back. Those 5, and then we have 13. Some of these 13 are my replies already. I've replied to everyone in here unless there's a new one that I haven't seen yet. Okay, in order as they were posted. Market breaking out above your QQQ and NQ short. I closed mine since TLT and CB were hitting new highs. Okay, and then we're at a critical juncture. And by the way, I appreciate all this. There's, a lot of you encourage everyone to share analysis. And this maybe be the case if NQ can break out above. But the first part here, I don't know what that means. Market breaking out above your QQQ and short. I don't see any breakouts in the market. And I went on to say, of course, close any position you're not comfortable with. So here's what I'm seeing today. TLT is approaching my 4th and final target on the 60-minute chart. Let me just jump over to that, and then I'll finish reading my response. Remember all along, I've maintained T4. I never cancel it, took it out. What that means is sometimes when we hit a target, I will say, okay, I'm closing that trade out. I'm removing T4. T3 is a final target. I thought the odds favored a pullback before then when we had T3 was hit and we had a divergent high and we didn't get it. But at this time, I said I'm very much open to continue to move up to T4, and it wasn't much more. So it's worth it even if you did short TLT last week. It's only from when T3 was hit, it's a total of 3%. And we are now almost there. And so the one thing, again, if you followed me for a while, the reason I'll typically list a final target, that's usually the end of the run. Not always, but more often than not, and you can go back if you followed me for a while, it's pretty impressive how often when the final target's hit, and again, I'm longer term. I'm still, to be clear, I'm still longer term bullish on treasuries. This is just kind of for this swing trade. That's when this swing trade will be closed out, booked. That's a significant downtrend line right there. And there's price resistance. And we're, for all intents and purposes here, we're a hair below it. So right now, if I thought the risk reward was not favorable for going long or being long there, well, it's a lot less favorable there because we're all the way up to, we still have the divergence. I just pick up the divergence line and move it. That's all. Just like in football, you get the first down, they pick up the first down markers, move forward, you got another 10 yards. So, and at some point, if you don't convert on fourth down, you lose the ball, right? You got to punt it. So that's where we're at right now, and the divergence is still intact. I didn't mean to exit out. I'm just saying if we continue up here, and then that's that. Daily chart. Let's take a look. Remember, I gave you a potential T2 as well. Where did I put the notes? I think it was the first of the downtrend line or that level, and you have the moving averages, and we're coming up on that trend line right now as well. And that's probably, that should be the same trend line I just gave you. It's just coming in a little higher the way I had it drawn here on the daily chart. Point being, we're really coming up on resistance on TLT, and that's it. Oh, okay. Well, let me move forward, because I'm going to get to what I was going to say in here in a second about I'm starting to see, and again, I'll get here in 1 minute, a little bit early signs of a disconnect between that hypersensitivity between the stock and bond market, or the very high correlation, I should say. All right, so let me get to that 1 second. Okay, so TLT is approaching my fourth and final target on the 60-minute chart with a reversal from or around that level, likely in my opinion. I also like the fact I'm starting to see early signs of that transition from the strong positive correlation between the stock market and treasuries, with TLT up strong today. TLT is up about 1.5%, 2%, I'm sorry. And the large caps flashing between red and green, mostly flat. It looks like a broken street lights going red, green, red, green. If you look at SPY and QQQ all day, they've been crossing, they're hovering right about flat all day, going into negative and then going positive. And so and it's not the first day I've seen this. So again, 1 day doesn't make a trend, 2 days, but then once you start getting a series of days, and again, every trend I'm looking for any type of evidence, and I'm starting to see that again. And this isn't treasuries being up 0.3% today and then the market being flat. No, that's a big difference. 2% is a huge lift on TLT. And to see the stock market trading flat or red, and I'm talking about the S&P 500 and the NASDAQ 100, the large caps, that is showing me what I wanted to see and what I've been positioning for. I told you that I'm still going to most likely keep core holding in bonds, long bonds, and expect at some point we'll see stocks start to correct. We're going to see the return of the inverse correlation, where if I'm correct, the major theme going forward from here into 2024 will be stocks going down and overall bonds quite possibly rallying, going up in price, with yields dropping for the reasons I've stated before. Flight to safety bid, deflationary forces, of course, lowered economic growth expectations, et cetera, et cetera. Okay, QQQ is still well off its recent high. That's what, there were a couple of comments about, the Qs or the S. I didn't see anything break out. In fact, the small caps are down like 1.5% today. So I don't know, and the QQQ trade's profitable, but it's well off its highs, but not by a lot. Remember, it's only, like I said, yesterday at the lows it was down 3% off the highs. So, but it's still below that, and we're riding that 60-minute uptrend line. This is what I covered earlier in the video, and so with the next sell signal to come on a break below it. So that's that. Randy, could this UNG level be an island reversal or an abandoned baby on the chart if it closes around this level? My reply is, all right, I had to pause the video there real quick. Somebody out back still doing a big major pool renovation. That's going on almost a year now. It's still going. All right. On the daily chart. Okay, yeah, that's right. This is what I was talking about, UNG, island reversal. I said, meh. If I have to squint and see if there are big gaps on both sides of a potential island candlestick, then I don't put too much into it. Plus, with the post-opening fade, most of today's gap has now been faded, which probably wasn't the case when you asked the question. So in other words, we had a potential for an island reversal. I'll get to the chart in a second. But then by the time I read it and replied, they faded most of the gap, maybe all of it now. Let me go check it out. So I gave you earlier the chart of NG, natural gas futures, but this is UNG. And you can see, so red means, we opened up, we were up here earlier, and so they since close the gap. So there was a potential. You would have had a gap there and a gap there. But by the time I started responding to the question, they'd faded most of that. And so therefore, now we don't have it because they closed the gap. So there is no gap separating today's candle on this side. So just that's that. The chart, just like NG, still constructive. Remember, we're in a downtrend. Natural gas is a trendy little sucker, I've always called it, meaning when it wants to go up, it can go up, up, up. And just when you think it can't possibly go up anymore, it keeps going up. And then sometimes, same thing in reverse. It can burn through divergences. It can make overbought and oversold look like they're not even there. In other words, you keep getting more overbought on an uptrend or more oversold. Just know that. I always say, I have a lot of crap I make up in this game, and one of them is I call it know your security rule. It's kind of a spin off the old when I was a broker, know your client rule. FINRA rule number, I forget the rule number now. You must know your client's situation. And I say when you're trading, know the security you're trading, whether you're trading futures or stocks or bonds or commodities. They're all different. And UNG or natural gas, they call it the widowmaker for a reason. So just, it's just one that you don't want to get under water with and just ignore stops because you think it can't keep going against your position. Because it can and it often will. All right, so with that being said, let me give you the update on it. So that's that. I answered that question. And again, I'm getting ahead. I did reply to somebody. Oh, no, it wasn't somebody else. Right after the post this morning, I followed up with this chart because I noticed the fade. So the reason I posted it as a long is we broke above this level here. You can see that little, there were several reactions there. It was support. Then we gapped down below it and we back tested. It gave another reaction to help validate it, rejected. And then we broke out this morning. And I debated waiting a little longer, but natural gas, because it is getting oversold and there are nice positive divergences. I didn't want to wait too long because I figured if I waited to see if we had a solid close above there or daily close, the darn thing could already have hit the first or even second target by then. That's when they start running into it. It can really run. Anyway, so, now I don't think I jumped the gun completely because it's still, as I mentioned in the update, which I'll probably get to in a second here, you have the downtrend line, which is basically, we're right on it now, back testing, and you have this minor uptrend line, and so that could be a very tight stop, which we just pierced below, but I also set on a 60-minute close, ideally, meaning a 60-minute candle. Or you can see I had the other orange line a little bit below the recent low because I think if they get there's the low, they'll probably take it out. So that would be, those are both tight stop levels if you're in it. I don't know if I'd take it now because we failed that pop of two. I would wait if I didn't own any or if I planned. And I took it, by the way, and I have it. But I'm not going to add unless we take that level out. If we pop it again, it should run. Otherwise, I'm more concerned about just mucking my hand, stopping out if we go much below that line right there. All right, next up, silver. Randy, I want to know your thoughts about silver. Okay, so remember, at least recently I was posting the euro, US dollar. I haven't been covering gold and silver as much as I usually do, but one thing I can say is and I've showed it many times, and this video is getting a little long now, so I'm not going to digress into too many other charts. You can look at the immutable, unmistakable correlation between the euro-US dollar pair. It's a positive correlation. They go up and down together, and that of gold and silver. And it's simple because the gold we're trading here and the silver is priced in US dollars, so rising dollar is bearish for gold, falling dollar is bullish. There it is. There's silver right here. So that's when we had a divergent high in silver, just like we had a divergent high in the euro US dollar recently. And there's the correction. It's been a pretty decent one. Support right there. These are old levels. I haven't updated them, but they should still hold. And again, simple stuff. Look, divergent high, correction, divergent low, rally, divergent high, correction, divergent low, rally, divergent low, rally, divergent high, correction, divergent high, correction. I'm longer term bullish on silver and gold right now. I think it makes sense to have some money in long-term funds, a certain percent of your portfolio. How much is up to you. Let me give you the other chart. All right, so that's it. So there was the divergent high. far from mere coincidence. That's when silver and gold, they put in their divergent highs. The euro broke down from the bearish rising wedge, fell, hit my first target, bounce, or was this first target here? Bounced, hit the bottom of that bounce target zone I gave you, rejected there, and now we're coming up on my next target of 10. It's about 106 right there. Pretty decent support. You can see a couple reactions on the chart here with positive divergence. So I think the odds favor a bounce right there. Remember, the stock market also tends to trade largely in line with this as well. So we could get a bounce in equities there. It's my best guess. I think the odds are favorable, and that was posted this morning. So that would make a case, that silver is probably going to bounce or could even end the correction. I just wanted to toggle over. There's the live chart right now. So that's it. So we're close. I certainly wouldn't be shorting the euro right here. If anything, I'd be covering and going long. If anything, I don't have a position there. I'm just using it to kind of get an idea on where the market might be headed and where gold and silver might be headed. All right. Obviously, our short thesis is not playing out. I don't know what position. Like I said, QQQ is positive. We have a short on socks I posted, a few weeks back. And that's, it's not on fire, that's for sure. But the semis are still. Where was the targets? Where did I put them? Maybe I just gave the setup there, the divergence, the breakdown of the trend line. This is a 60-minute chart, but you can see the semis have, I won't call it a rollover. It does look like it's kind of a rounded-ish top, but they peaked back here. They've been moving lower, and I always say I consider the semis to be the canary in the coal mine for the tech sector as a whole, and the tech sector, of course, being the stock market due to its weighting. And so, this is called not a red flag, but a yellow flag so far. Maybe it's just a correction after a strong run, or maybe it's more than that. There's your bearish PPO crossover. Last time we were this oversold, and followed by a high-level bearish PPO crossover was right here. There was the oversold. We started to diverge. Lines flattened out. We had a high-level bearish PPO crossover there. And then the semis from that point dropped 20%. Of course, similar technical posture. There was a high-level bearish PPO crossover right there. Big drop. High-level bearish PPO crossover right here. Big, pretty good size drop. So that's what I'm looking at on the semis. So we were going up, we were going sideways, and now we're going down with a bearish PPO crossover. Oh, and the other one that I can think of offhand that was an official trade, ITB. Yeah, that one's not, it's not, it's underwater. We shorted it right here, but not by a lot. And I told you I kind of eliminated that bull flag potential because it went too long. It's not symmetrical anymore with a bull flag. So this one is down by a couple, 2.5% or so. I think it was right about here we shorted. But other than that, I still like it. In fact, if I jump down, which I just did, do a 60-minute chart, you can see we have, we had divergence here. I think that was where we shorted it. Oh, we had a divergent high on the 60 right here. And the stock corrected. But I always say stocks can correct people think of corrections as in time. They can, in price, but they can also correct in time, which it did here, sideways. But it went up, made a marginal thrust higher, and still just very much all it did is extend the same divergence. So divergence is extended, and that's about it. So that's the home builders. Yeah, still liking that one. All right, let's wrap this up. This video is going long enough. Lithium stocks, what are your thoughts on lithium stocks? Here's LIT, lithium stock ETF. That's it. There's your downtrend line. We've got a little wedge forming. Zero evidence, as I said in that reply, It's in a 110% a downtrend. There's no mistaking. It's not like you don't have to stare at the chart to be an expert. So, and there's no buy signal, nothing remotely close to a buy signal. I don't see a selling climax, any type of bullish candlestick reversal, any type of break of support. We're below all our key moving averages, even the short-term ones. But a break of the trend line could do the trick, and there would be first target around 51 or so, and then 58, a second target. Fundamentally, it makes me think, and this just, I was going to add this in there and just got started to get too wordy. I do have some fundamental thoughts. Number one is a trend that I've seen for years now. I started and I talked about it. This was back, 10 years ago. I started to just see, and this isn't anything I read, just kind of observations, that the countries, it was ExxonMobil and Chevron, the big oil companies back 10 or 15 years ago. It was major tops put in those guys at the time. The charts were saying it. But I noticed, a lot of the oil, especially when this country, hasn't always been so friendly for drillers, the big oil had contracts, in all these countries like Ethiopia. Don't hold me to the name, but all these obscure, a lot of African and other countries out there. They had rights to drill and produce oil. And I think in what we're seeing, and this is going where I'm going with lithium, with the rare earths, a lot of those other things, platinum and palladium, the palladium group of metals, platinum, palladium, rhodium, those are a great example where the majority of them are not produced in the U.S. Their reserves are elsewhere, outside the U.S. China has a lot of the rare earths. Russia, I believe, is the largest or second largest producer of palladium. And so where I'm going with this is the trend that I've seen are these countries have now realized, back in the day, they were happy to take the, money from ExxonMobil to let them drill on their land and take the oil and give a cut. We don't have the expertise or know-how. But a lot of these countries realize that, hey, these are our resources. This is all we have. And we're seeing, of course, we're also seeing deglobalization lately. And we're not making any more friends. We have a lot fewer friends today, I think. I'm talking about the U.S. than we did before. The BRICS are trying to do their own thing. Talks of them developing their own currency, commodity-based currency, or at least based on maybe tied to gold. We'll see, pegged. Trying to get away from a lot of... the U.S. doesn't have the grip that we used to have on the rest of the world in these commodities. And so where I'm going with that is, okay, so we're not a major producer of lithium. And so these companies, I don't know. It's just kind of a little fundamental rant here, but it ties in to what else I was thinking about. And I mentioned this the other day is, we had this Biden's big green energy plan, and it was supposed to send all these electric car vehicle makers to the roof, to the moon, and the battery makers and lithium. And why hasn't it? Why are the lithium stocks down here now? Whereas going forward now, you can see we're running out. The U.S., our debt is spiraling out of control, and now it's becoming an issue. There's talks about a U.S. downgrade again. The budget shutdowns. We can't, last time around they voted not to give money to Ukraine. Now we got to support Israel too. And Congress is starting to say, hey, we can't keep doing this. We're going to have to make cuts. And we all know we're not going to make cuts to the social programs. And so where I'm going with it is, how much more money, how much more subsidies? Are we going to have more subsidies if a lot of these green companies aren't rocketing right now with the subsidies they're getting? How's it going to look a year or 2 years from now when the U.S. realizes, guess what, we don't have the money to pay for it? We might have to roll back some of these, green subsidies and huge things like that. So I don't know. I don't know if that plays into lithium or not. But bottom line is, here's a bullish falling wedge, and it doesn't. That's kind of long-term macro stuff, whether it plays out or not. There's your targets if it breaks out. There's your wedge. The divergence has to be confirmed and all that. So let me move on. Oh, that was lithium. Scrolling down, I already got to NG. I jumped out of that, showed you those potential stop levels if you want. And is that it? That was trade ideas. That was yesterday's video. No, that was today. Okay, we're good. Unless there was something put in there since. All right, those are all the questions. I updated the markets, Treasury bonds, and the euro. That's the big three. They determine pretty much where everything else goes. And just to wrap it up, keep an eye on the economic calendar this week. We had the JOLTS report come in, and they were expecting a consensus of 9.4 million job openings, and there were only 8.7 million, so we missed there. I feel strong, as I know some others do, that the last pillar to go before a recession is the jobs market, so watch that. I can promise you the market will be watching it very closely. You've got tomorrow ADP employment report at 8:15. You got a couple other things on the calendar you can see here. You have jobless claims on Thursday at 8:30 and the employment situation. So plenty this week on the calendar regarding the jobs market. And it's either going to make or break this rally. You can either continue to keep the bid under equities, or boom, maybe those divergences start playing out for a much bigger drop. And maybe these are the catalysts, maybe not. All right, I'm going to wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.